Welcome to another episode of Arjava, where we talk about how rules rule. And at DSP, we take a lot of pride in having a right process, a right framework to our investment journey. We also have a lot of diversity in the styles, a lot of think quality, value, growth, and we have different fund managers practicing each of these frameworks. And today we dive into one particular style of an opportunist, Rohit Singhania, who is the co-head of equities at DSP and manages a couple of our funds. Rohit, very happy and delighted to host you today. And what exactly is your investment framework? Could you just run us up in 2 minutes?
Thank you, Ankita, for having me here. I think when you look at investment frameworks is, how as a fund manager do I analyze companies? What goes into understanding those companies and how I get them into the portfolio. So if you want it in simple words is, I like companies, I like buying companies, typically, growth at a fair valuation. Everyone looks at business cycles, business qualities, the management of the company, how the balance sheet is, right? That is a key ingredient for every framework. But what on top of it, I try to do separately is have something like a margin of safety. So if you're buying something, what are you paying for it? Is it worth that? Can the value increase or you're paying a top value? So usually I don't like paying top value for anything. And there has to be a margin of safety at what price I'm buying the stock and what returns it can give me over the next 1, 2, 3 years. That's one. In addition, when we talk about business cycle, what is the business mode? Take, for example, an auto company. So what segments is an auto company prevailing today? What are the competition doing? What is the outlook for that particular segment? So just because you're an auto company, it's not everything doesn't fall into one basket. You have to break it down into segment wise. That's how the analysis is done. Then you look at the management. What's been the history of management? What they have done during bad cycles, good cycles, what their behavior has been. So that gives you some sense, right? If things go wrong in the future, how they may act or react. Third is, in the end, what are you paying for it? Is there a margin of safety? And when I say margin of safety means at what value are you buying the company today? And how do you compare the value? What was the company trading at last 5 years averages, 10 years averages? What was the sector trading at those averages? So if you find comfort in all these three, you go and buy ahead. So I would say again to reiterate, buying growth at a price and keeping margin of safety. That is the core of my framework.
Sure, Rohit, and I'll pick you up right here when you say growth at fair value. So what is the use case of your framework? Which kind of investor do you think this framework is most suited for?
See, I would not like to categorize which kind of investor, right? I would rather say which kind of markets, right? So if you look at it, last 2 years, the value style, so-called, which I believe in, has been doing very well. Prior to that 2 years, growth was doing very well. So I think this growth and value is a cliche. So what when you look at it, you want to identify buy companies who are doing good business. They have a good leg of growth over the next 2, 3, 4, 5 years, and their management is stable. On that, how do you overlay that valuation aspect, right? The margin of safety. So what I believe is, investors who are looking at value growth idea is what the fund manager is doing over the cycles. And if the cycle is going against the value or theory of the fund manager, what corrective action is taking. Like if you read my framework, which is clearly mentioned on our website, right? It says at times up to 30% of my portfolio can be in stocks which completely don't meet my framework. That means on terms of valuation, there is no margin of safety. The stock is very, very expensive. But if as a fund manager or as an analyst, I feel there are certain stocks inherently with something great is going for them and that can continue for a longer period of time, and though they are expensive and liquidity in the market is abundant and cheap, then it's prudent to have at least a benchmark weight in those stocks. So as investors, I would say markets are cyclical, but if a fund manager is sticking to his or her core philosophy, then at times you may underperform if the cycle is not right, but eventually you will get back. So that would be my answer to this question.
So Rohit, you are clearly an equity opportunist that you are known to be. And before we dig in, your framework says that you're not inclined to hold forever approach. You also mentioned of corrective action, building tactical position. What is your average holding period? And what brings the conviction in you to be very different from the age-old, buy and forget kind of approach, despite you choosing stable businesses and stable management?
So, Ankita, when I analyze business, right? So, I don't have the capability of analyzing business for the next decade. In today's world, things are so volatile, and preferences and outlooks change. So, usually, when I enter a position, I take 1 2 year view, and every quarter, every 6 months, we try and build on it and see whether we are going in the right direction. Our conviction is still there, right? Sometimes so happens is you're getting it right, you're getting what you want. So I believe in a concept of fair value. So whenever we buy a stock, there's a target price in mind, and that is based on what business growth can happen over the next 2 years. Some call on valuation, though it's a very difficult call and tricky call, at what value this company will be traded. But history tells how things move. So that's how the exit is decided. So either you reach your fair price of the business and you say, okay, it's done with, or as an analyst, as a fund manager, I've gone wrong in my thesis. Right? I bought a company, keeping this thesis in mind, and something horribly, or it's not working. Right? It's been 3 months, 6 months, and when you're meeting the management, seeing the competition, maybe you think that's not going to play out. So again, what ideal is, when you get your thesis right, you get your price, you book out. But when things are not going right, you have to cut losses. That's what I believe in. As far as holding period is concerned, holding period is totally determined on the business cycles, how the business is moving, whether it's moving in your direction, you're saying, or you're getting it wrong somewhere. One. Two, I may hold a company for the last 10 years also. So, right, so if you ask me what is the holding period, I will say 10 years. But what has been my portfolio weight in that company? Has the weight been same across the 10 years? It will never be the case. So when you feel suddenly the stock has done well, it seems to be fairly valued, though you have a long-term business trajectory. At that point of time, I don't mind reducing my weight. At same time, I may see, okay, due to certain external events, which is not the doing of the company or the sector, the stock suddenly falls, right? For no reason of its own business. I may go and add that weight. So weighting of the stock will be volatile, but the stock holding, if you see that stock would be in my portfolio many years, but the weights may be different. So when I look at holding period, for me, it's the weight, how am I sizing my portfolio, and what is the reason behind it.
Sure. Okay. So Rohit, I think you put a lot of emphasis on sizing the stocks in your portfolio, but also you've spoken of valuations, you've spoken of margin of safety that you take while constructing your portfolio. So now help us with examples and different scenarios when valuation opportunities do arise, and what are your checks to avoid a possible valuation trap in these scenarios?
Okay. So what I'll do is I'll give you one or two examples, but that doesn't mean I'm trying to promote or put down a certain company, right? It's just for example. So about I think 2.5 years back, I added a lot of ACC cement, ACC Limited in my portfolios which I run. At that point of time, I had an Ultratech also. So what was the view of the cement industry? What was the view of the fund management team, right? Cement is going to grow strongly. So you want to be in companies who can track that growth. The companies who are not going to track that growth because either they have capacity constraints or something, they'll be loosely valued, they'll be valued at a discount. So at that point of time, Ultratech was trading at a significant premium to ACC. The reason was Ultratech will match or even outgrow the industry growth. And ACC, because of capacity constraint, if industry grows so much, ACC will be below the industry growth. So market was valuing these two things differently. Both companies are well run, good management, so balance sheets, no issues. So as we saw the cycle, maybe slowing down, during the COVID time. So the view was what the projection of industry demand was there for cement growth, that was going to come down. So here you were stuck, the view was now the growth is going to come off. So is ACC going to lose market share? No, that's not going to be the case. Whatever production capacity ACC has, they can match it. So, and discounts at more than 30-40% premium, discount to the industry leader. That's when they decided, okay, let's move out a little bit and add more ACC, and absolute levels add more ACC. So that worked out, right? So same cement company, same financials, but in which how the market is perceiving that industry to grow, that drives, performances of individual companies. So that ACC, we had the margin of safety in terms of valuations. You had the industry leader trading at a significant premium. Two, the difference in performance was coming down, right? In terms of underperformance in business cycles versus the industry leader. So that's how I try to look at things and identify companies within sectors. And if you get outliers like that, we take benefit out of it.
Sure, Rohit, but I'm still waiting for your checks to avoid value traps.
Okay. I think so when you're buying companies, who are value traps are usually in cyclicals, I would say, cyclical businesses, where you think, okay, PE looks 2 or 3x to you, or price to book 0.5, 0.6. You think, बहुत सस्ता है. So, but how do you avoid value traps in this? So when you're buying a business at those valuations, there's a reason for it, right? Historically, things haven't been good, or the expectation is it will continue to be bad. But there are certain business cycles, I would say. So I will give an example of commodities, right? So commodities, my view is if you buy a commodity company at 0.5, 0.6 price to book, the probability of you losing money is very less. So what do you look at these senses? Is something which has happened last 2, 3 years changing now? And I again give you a bit example, not naming a company. So suppose an XYZ company has done huge capex in the last 3 years. And during that time, the cycle for that particular sector industry was not that great. So if you look at the balance sheet today, it'll be a horrible balance sheet, right? With higher net debt to equity ratios, interest coverage ratios very low. But if you see at that point of time, the cycle is turning around, and that sign you have to really work hard, right? See what's happening to the particular sector, what the competition is doing. And when you get confidence, things are going to turn around. That's when you say, okay, now I want to invest in this company. They have done the hard work, taken the pain in last 3 years, you take it. Value trap is when you just go and buy this company is cheap, let me go and buy it without understanding or analyzing the business. So that's how I see it. And one example, I mean, if I can add that, Ankita, so this is how I talk to bankers or fixed income colleagues of mine, right? At certain point of time, an equity investor would like to give money to these companies because they're at the bottom of the cycle, the balance sheet is bad, and things can improve. A debt investor will not give. A time comes when a debt investor is ready to give money because the cycle has been good, the company's balance sheets have improved. As an equity investor, you feel okay, abhi, things have done, the stock is fairly valued, let's try to book profits out of it. So that's how I look at the value, and are there any traps into that number? What you're saying?
Sure. So that's very insightful, and it give us more confidence that there are very comprehensive checks there. Now, what is your claim to alpha? Any outlier idea you're convinced you should place a bet to generate alpha? Would you go ahead even if, let's say ROE is not then greater than equal to 12% as your framework puts forward?
See, as I said, my claim to alpha is first to understand the business of what I'm buying. What can be the risks associated? Because we sometimes, as fund managers, investors, analysts, right? When we look something positive, sometimes we dilute the negatives. So idea is to look at the risk also. If I go wrong, what can be the downside in my particular holding, right? So once you understand that and you try to weigh, and the stock weighting also, the liquidity has a factor, right? How many stocks get traded? What is the average volume? So in case I want to, move out of it or move, what is going to be my, entry exit cost for buying that stock? So if you have those business cycles right, some sense on the management and the weighting right, and again, what I said in the beginning, margin of safety. If you're not overpaying and you get it right, I would say that would be my claim to alpha, and hopefully that would work for me. That's how I would put it, Ankita.
Yeah, right. So I think that's kind of sums up what investors have to seek from you. Any nuances you want to bring out about your portfolio construction aspects, especially sizing that you had touched upon in the starting?
So for me, when you're buying a stock, you're buying with a view. Idea is if you get it wrong, take corrective action,
Sure.
right? It's like, what you do in a regular household thing. Something is not going right, you change it, right? The stock, yes, you have done your due diligence, you've done a lot of hard work. But when you realize something is going wrong and not going as per what you had expected, you should not get scared or worried about to take corrective actions in a portfolio. That's one. Sizing, as I said, you'll see a particular stock in my portfolio for last 10 years. But the weights depends upon, where the business cycle is, how things are going to happen, or what is the expectation. I would say that's the two key aspects I would answer that question.
Thanks, Rohit. And I think I will leave the investors with that thought that, when things are not right, take corrective action, be agile, be nimble. Thanks, Rohit, for joining us today.
Thank you, Ankita. Thank you.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.